Hi, good morning. We sent you a note yesterday, worried about this week from a market perspective, really for two reasons. The first is that we had major options expiry across the market on Friday in a market that basically on a S&P basis was 2-to-1 puts to calls, which meant that fairly obviously if you have options expiry, there's going to be a squeeze higher as you close all your puts out. And secondly, that Schlumberger reported a beat, but underperformed quite badly on Friday, and we thought that was a bad sign for the oil service stocks, which have been really the strongest sector in the oils. Baker Hughes reported, sure enough, this morning a miss. And so we're a bit worried about Halliburton tomorrow and the fact that essentially these oil service companies are getting back towards having a premium multiple. There's a couple of other results this week that are very interesting in oil. Hess doesn't trade so much on earnings as on net asset value, so the earnings report is less relevant to where the stock is, although it's at an all-time record high, over $150 a share. We still think that based on Guyana value and inventory and profitability, you can get to 200 over time on Hess. Having said that, a client, for the first time in months, a client actually pitched the bear case for Hess to me last week, which was essentially related to the cost of FPSOs, the floating production storage vessels, the potential for changes in the PSC, and maybe just risk to the overall profitability of Guyana going forward. But broadly speaking, the market rightly sees Hess as a huge NAV play and is trading it accordingly. More important for earnings, which trades very much on its earnings, is Valero. And the issue there is, firstly, that Valero hasn't missed a quarter since 2017, believe it or not, and has only missed twice in Joe Gorda's entire decade of being CEO. But of course, the trick there is they tend to talk down numbers into the earnings report. And if you look at the earnings estimates for Valero on Thursday, they've actually gone up into the print and are at a staggering $7, over $7 for Q4, which is going to be quite a high bar for Valero to beat, really driven by Exxon's positive guidance for their Q4 refining earnings as much as anything. But the bar is quite high for Valero. That said, unlike Schlumberger, the stock is, over about $140 a share and making about $28 in 22 based on the $7 Q4 estimate. And that means that there's room for them to miss, if you like, because the stock's only on 5 times earnings. And then finally, Chevron, we've been arguing that arguably maybe if Exxon's getting more into trading, and there's a lot of debate over how much derivative impact Exxon is facing in its Q4 results based on its guidance, which might imply that Exxon's trading a lot more, then maybe its earnings are going to get more volatile, like Shell's low multiple, as opposed to Chevron, where I was with the CEO late last year, and they really aren't interested in more trading than they already do for operational reasons. And so you could argue that the outlook for Chevron versus Exxon as earnings is that Chevron has lower volatility earnings. Having said that, Chevron's missed a couple of times in the past 5 quarters, whereas Exxon's only missed once. So that's a shift that's not evident in the trailing numbers. But of course, if Exxon's trading more and the market's more volatile, it should become more visible over the course of the next 5 quarters. We shall see. And apart from that, there's a couple of other things reporting, like a lot of things, including a company called Tesla. So we're kind of bearish for the week. Have a great week. The oil investment case remains very much presaged on the oil as being fair value if we hold 80, and exciting if we head to 100, and the market believes that 100 is the sustainable number based on the continuation of the oil age, the lack of oil substitution, if anything, the regression back into more oil demand that we've seen over the past year. The potential, as we wrote on Friday, for 1 million barrels a day of growth in jet fuel demand alone in 2023 is very bullish. And of course, the supply side remains extremely challenged, and we'll be watching natural gas markets where supply is abundant. The Widowmaker March-April spread has gone to 0, which is very bearish, telling you that we didn't have a winter. And right here, we still haven't had any snow in New York City this year, which is the longest run for many, many years with no snow in New York City. So natural gas looks pretty weak, and within that, NGLs look weak. So we're not entirely convinced that the E&P companies are going to blow it out. But with all that said, the supply side for oil looks very challenged. The demand side still looks strong, and therefore the potential for us to make that move to 100, which essentially everybody's calling for this year, which worries the investors, the potential is still there. And if we do make that run and structurally price above 100, one thing that might make that happen is that we do believe that Saudi needs over $90 to maintain its spending, And that, of course, if Saudi wants over 90, you're probably going to get to over 90. And if you go to over 90, you're probably going to get to 100. All right, have a great week. Thanks.